Good morning, advisors, investors and shareholders of APL, and welcome to Antipodes Fortnightly webinar series. This is Matt Dell. I'm a director at Pinnacle Investment Management. Pinnacle is the distribution and minority equity partner for Antipodes. We manage all the non-investment related services for Antipodes, which enables the Antipodes investment team to focus exclusively on managing yours and your clients' money. Our speakers today are Nick Cameron, Portfolio Manager and the Sector Head with responsibility for researching healthcare stocks on a global basis. Nick has a PhD in biochemistry, so he's well qualified to provide an update on COVID-19 and then provide an overview of Antipodes' positioning in the healthcare sector. We'll then hear from Jacob Mitchell. He's the founder and Chief Investment Officer of Antipodes, and he'll provide an update on the current portfolio and positioning. Today's presentation will go for about 20 minutes or so, with the opportunity to ask questions, which we will take at the end. And you'll notice a Q&A button at the bottom of your screen to enable you to do this. So let's begin, and I'll hand over to Portfolio Manager and Healthcare Sector Head, Nick Cameron.
Thanks, Matt. Thank you, Matt, and good morning, everyone. Thanks for joining us today. First, I'd like to start with a bit of an update on what the COVID-19 situation looks like. And I think thankfully we can see from the data that around the world, across multiple geographies of the outbreak, that the curve has indeed started to flatten. New case growth is continuing to slow across many of these areas, and even in the ones that have emerged as later outbreaks. We're seeing that social distancing has indeed worked to some extent. And now really we're going to consider what the next steps are. And the next steps are that many policymakers are considering is, of course, when to lift restrictions. A bit of common sense and a bit of historic knowledge that for example, the pandemic outbreak in 1918 through to 1919, or the Spanish flu outbreak, saw multiple waves, 3 in fact, across a period of about a year and a half, maybe 2 years. And so this is a key consideration going forward if policymakers do indeed decide to lift restrictions. But before that, going into that in more detail, I'd like to just give a quick update on where we are from a therapeutic perspective and also from vaccines and herd immunity and what all these mean. So to begin with, on the therapy side, we're seeing multiple drugs now being widely used in the clinic to treat COVID patients. These are not approved drugs, and there are many examples you may have heard of, including malaria drug hydroxychloroquine, and including also Gilead's drug, which is an antiviral called remdesivir. These drugs have the potential to, I guess, slow or shorten the duration of the disease, and in some cases the severity, which may in fact also lead to better clinical outcomes or removing the need to see or to visit an ICU. So where we are on those drugs in particular is more data is emerging. The early signs are positive, certainly in the lab setting. There's some very strong antiviral activity from both Gilead and the malaria drugs, and also one other for head loss that you may have seen in the news. Secondly, just talking about where we are with herd immunity. Now, herd immunity basically provides protection to a population if a certain amount of people have already been exposed and have immunity to a virus or disease. Now, there's no magic number for COVID, for the SARS virus in this case, as to how many people need to have had immunity or exposure, but there's been multiple experts that have thrown around a number in the 60% range, which is at the moment difficult to determine where we are on that curve because we haven't had the benefit of seeing a wide or a very broad based testing regime implemented by really any country at this stage. So where does the 60% number come from? There's been multiple studies across various different viruses and outbreaks, and you could use an extreme case like measles where you need at least 90 to 95%. But in this case, I think what we can deduce from history is that around 60% at least, you can start to see that having an impact on the spread of the virus and slowing it. And if indeed through social distancing as well, if we have those two in combination, we should see slowing. The key question then is, before vaccines arrive, is how do we know how many people are immune? And really it's until then, we don't know, because widespread testing, number one, and number two, we haven't studied these patients for long enough after they've recovered to see how long they're immune. Now, in the past, we've seen coronaviruses such as SARS outbreak in the 2002-2003 period, where immunity can last years. But in the other case of another coronavirus like common cold, immunity may only last months. So really, it's a bit of an unknown at the moment, but a general rule of thumb across history is that typically the more serious the viral illness, the longer duration of immunity that recovered patients can have. Until we get widespread or large-scale ramp-up in testing for immunity, and this tests for the presence of antibodies in people's blood, it's still going to be an unknown. But that said, there are multiple companies that are building up this capacity in these tests right now. And we expect this will be something that you'll hear a lot more about in the months to come. Finally, vaccines. One of the good news stories about COVID is just that the actual virus itself makes it quite amenable, or makes it potentially targetable by a vaccine. That is, unlike an influenza virus, it tends not to mutate that much, or one of the critical areas of the virus and how it works to get into cells does not seem to change much. This means that a vaccine, in theory, should have quite a good probability of success of working. But this is at least probably 12 months away. And so where we are in this journey at the moment, there are multiple people developing vaccines, multiple companies, some with incredible scale in producing vaccines like Merck, Sanofi, GlaxoSmithKline, but there are also a range of other smaller companies that use novel methods to develop vaccines. Just given the focus on this outbreak from the scientific community and from governments, there's been a huge focus on developing targets for vaccines. And right now there are multiple in development. Our latest checks of clinicaltrials.gov, which is the website that tracks clinical trials in the US, see that there's been more than 60 studies initiated for therapies and vaccines against the COVID virus in just the last few months. Just moving on to where we are then, finally, there are a number of vaccines that have just started human trials, 2 in fact from when I last checked yesterday. And so I think in terms of the ability to see if they're going to work or not, we'll probably have to wait for the next few months. At least the next few updates on the drugs are probably going to come in the next few weeks from Gilead and also from the malaria drugs. So where does that leave us? So when we're waiting for a vaccine and waiting to find if drugs work and the curve's flattening, governments are stuck with the decision of whether to keep social distancing and restrictions in place. And until we have a vaccine, which is the ultimate remedy for the situation and provides ultimate confidence for governments to take the chains off the economy and for people, I think we really need to consider the healthcare system's capacity or ability to be able to deal with the severely affected patients. And that is particularly looking at ICUs. And so whether or not this virus is a seasonal virus, or whether indeed early relaxation of restrictions sees another wave coming, the ICU and ventilator capacity will be the key metric that policymakers will consider when they're looking to lift restrictions. And so, for example, we've taken a look at some of the major geographies across the world at their capacity or ICU beds. And what we've done is represented in the chart below is run a scenario and basically made some key assumptions, being one, if we assume all ICU beds now are 50% available, that assumption is based on, at any one point in time, there'll be car accidents, trauma, multiple critically ill patients that will need ICU anyway, as an underlying, let's call it baseline activity. And through the actions of healthcare providers and hospital operators, they've been able to free up a bit of capacity as well from elective surgeries. So we arrive at a fairly broad assumption of, let's say, 50% of beds are currently available for ICU COVID patients. Based on Chinese data and also experience from other geographies, including the US, it appears as though roughly 5% of COVID cases may require an ECU visit or ventilation. And so using these assumptions, we have a look at what the current caseload is in some of these countries. And you can see on the dark bars on the column chart below, this is what the current beds, ICU beds that are available per 100,000 head. And then next to it in the orange, you can see these are the potential cases based on the current number of cases and 5% of them requiring ICUs. And what you can see is that in some of the European countries, particularly Italy, France, and Spain, that there is quite a shortage there. And there's probably a direct link as well, or there is a clear direct link between the capacity to treat these patients in ICUs and the case to fatality rate. The good news story is that, or not looking at this chart in isolation, is that the curve is flattening and growth rates are slowing in some of these countries, in particular Italy. And so some of the pressure on the system may abate. But what's not clear and what is not represented in this case is just how much capacity is being added quickly, and also, you know, I guess what the potential second wave may look like and how severe it is. So just rounding out the conversation, I'm going to discuss just quickly how we look at healthcare and just some key points for investors out there on how we think about investing in the space. Typically what we look for are companies that innovate, not fast followers, that are ones that provide very innovative or novel products and services. And this can provide a wider moat against competition and also command greater pricing power in markets which are typically seeing very significant pressure on pricing. We're quite unique in healthcare, in particular biotech and pharma, where patents also provide a very strong protection around product revenues and some resilience longer term. We like companies with diversified earning streams, and that also can provide a greater margin of safety rather than having all your eggs in one basket. It also can provide lower earnings volatility in cyclically exposed businesses in healthcare, but also more importantly, I think in this stage of the evolution of the healthcare market, having multiple avenues or options to unlock value through other businesses within your broader business also provides optionality and potential to unlock shareholder value. Products and services that are less discretionary in nature as well is also something that we look for and have generally a lower chance of being deferred or being curtailed during times of need, during times of difficulty. Finally, we try to avoid exposures to companies or businesses that have a disproportionate exposure to government revenues and payers. Overall, we think these businesses are more at risk of having funding cuts, particularly when healthcare budgets are burgeoning with the ageing population and growing utilisation. Key examples of that we have in the portfolio include Merck, has a number of these factors going for them. Oncology is a very defensive and non-discretionary part of medicine. Its vaccines business is very defensible and stable through economic cycles, and also is the animal health business. Roche, as well, is probably the premier innovator in the pharmaceutical space. It's well diversified and margins are improving. And then finally, I'd probably just note just how wide the variety is of opportunities we have in healthcare. The valuation or multiple divergence between the various subsectors is quite wide. And you can see there that pharmaceuticals in particular have been languishing over quite some period. And it's no surprise that that's where we're finding a lot of opportunities at present. Thanks very much for your time. I'll now hand it over to Jacob.
Thanks, Nick, and welcome everyone. I'm taking up on slide 6 and just wanted to recap on where we're at in terms of government stimulus. As Nick mentioned, probably the good news is that the curve is simply flattening, and in key geographies like the US, we fortunately we still have capacity in the healthcare system to manage the caseload. And governments will really focus on that as they start to reopen the economies as essentially the scarce resource. ICU beds are the scarce resource. If governments can add to that capacity, it gives them greater confidence in terms of easing restrictions and ultimately preparing for a potential second wave as that happens. I think mentally we all have to be prepared for that. It doesn't necessarily mean we have to go back into lockdown, assuming the healthcare system itself has the capacity to deal with those severe cases. We are going to have to learn to live with COVID-19. The stimulus efforts from governments have been extraordinary. I mean, if you think about the level of GDP, just throwing 10% of GDP, 10% of the equivalent of 10% of GDP in terms of programs supporting incomes, supporting small businesses, households, rent deferrals, mortgage payment deferrals, regulatory forbearance. It is simply extraordinary. Now, we think some of the key longer term questions start to emerge from that. Currency, the alignment of currencies, the potential for, unintended consequences of all of this monetary and fiscal easing. So within the Antipodes framework that we have evolved in the, over our 5 years, coming up to 5 years of our track record of managing money for investors and shareholders, we've evolved this sort of simple schematic, and COVID-19 really pushed us from that bottom circle, the lower growth environment, straight to fiscal activism, debt monetization. It happened a couple of years faster than we expected. Fortunately, we had some downside protection in the portfolios. And the question is, how quickly do we go to the next circle? So fiscal activism, we think, it will keep interest rates low, but it will probably drive up the equity risk premium. Currency devaluation may be an outcome. And then, against that may potentially ultimately inflation. So, our framework, which is really discussing the idea of populism and what QE, the fact that QE has sort of somewhat intensified in populism by driving wealth differentials, but also keeping the cost of money low means that you potentially don't see the economy cleanse the way it should, i.e. disruptive pressures. If you look at the bottom chart there, on the left, and you see the bottom line, the yellow line, profit margins are have been under pressure for some time outside of the large cap technology stocks. And these companies have also tended to offset some of those pressures by lower tax rates, lower funding costs, and ultimately buying back stock. So balance sheets are not in great shape, which is what the chart on the right shows you. This growth in the BBB, that's the bottom rung of investment grade. If you compare the size of that relative to the junk market, alarm bells should be sounding. BBB downgrades in the capacity of the high yield market to really withstand the potential downgrades in a recessionary environment has to be questioned. And we can go into more details, but we've started to see those downgrades, 150 billion this quarter, which means the junk bond market has increased by about 10%. The leveraged loan market is really just the junk bond equivalent of loans. And the danger there is that roughly 65% of the leveraged loan market funds private equity. And those loans are then packaged up into CLOs, collateralized loan obligations. Now, these get rated, the top sort of, let's call it 60% of these loans, as they get mixed together, the top 60%, magically becomes investment grade or, A-rated paper. But that assumes diversification. Now, COVID-19 is a correlated event. It hits many industries at the same time. So some of those diversification benefits are going to break down, and some of that A-rated paper is certainly not going to behave that way. So let's keep moving. I think Japan is a great lesson in what happens when zombification occurs, when you have very, very low rates for a long period of time. Against the, much of the sort of prevailing wisdom, conventional wisdom, PEs do not go to infinitely, to infinite levels as discount rates go to zero. In fact, PEs actually derate. The equity risk premium goes up. Now, we would argue it's simply that because you don't have the economy cleansing, the weaker companies aren't leaving the mix. They are getting bailed out. It's because the return on capital in the economy starts to fall. Quite rightly, investors shouldn't pay a high multiple if returns are going to fall. But even against that, that may sound like a somewhat miserable backdrop. Do take some heart, because Japan still had a cycle, and we believe you will still have an economic cycle, and there will be choices. You will be given choices. Sometimes it will be the right, it will make sense to tilt towards lower multiple stocks, the stocks that have been hit hardest in this duration bubble. And that's typically when the economy is accelerating because of stimulus. And then it's prudent to cut exposure and pivot towards a more defensive growth bias when the economic cycle rolls over. In terms of the Antipodes portfolio, the Antipodes Global Fund we're showcasing here, but for the Antipodes Antipodes Global Long Fund, you can use this as a guide, obviously without the shorts. We have been absolutely finding value in some of those more cyclical parts of the market, but looking for secular growers in those cyclical buckets. Even with the downgrades that we're putting through, and we're haircutting our cyclical earnings for the market, like what we're showing here with the yellow dots is the valuation of the benchmark, not our portfolio, but the benchmark. And you can see, even before we put down, at the end of December, the cyclicals were trading on roughly half the multiple of the defensives, and that spread is approaching historical extremes. And even with downgrades, that spread doesn't really change much. And that's with us downgrading the cyclicals more aggressively than the defensives. Then from a regional tilt perspective, we've definitely been finding if you think about North American and the North American index, we typically are exposed to the global defensives in that market. So, we're measuring under North America domestic, the part of the market that is only, roughly half of the S&P 500 that is oriented towards the North American economy or the US economy. And we make no, we believe we're justified in having an underweight there, because you do not have a margin of safety relative to similar stocks in other parts of the world. Just moving along, in summary, like a very high-level overview of the portfolio. COVID-19 is accelerating some of the secular trends, whether it is just the superiority of cloud computing platforms in terms of facilitating remote working. If it's Alibaba in terms of delivery platforms, e-commerce, or food delivery platforms. There is economic sensitivity, though, in a business like Facebook, and it has derated. It is exposed to small, medium enterprise advertising, and it has been hit hardest out of that cluster. We think it's still a great, we think it will come through this, and it will come through this in good shape. But it does highlight that even in some of these secular growth stocks, you do have economic sensitivity. Enabling the future within predominantly a semiconductor cluster, but companies that are going to enable the adoption of electric vehicles, 5G mobility, memory, cloud computing, secular industrials and clean energy. We do see this as led by Europe and to a certain extent China, a drive to decarbonize, a major investment cycle that will ultimately, I think, be used to offset some of the COVID-19 recessionary impact. I won't Farmer with Pipeline has been handled by someone, by Nick, who's far more qualified than myself in discussing that cluster. And then we have the consumer incumbents, where we see interesting value in that, sort of, let's call it longer, that duration style business that the market loves, but in cheaper versions of those opportunities. Strong retail banks. Now, retail banks have not behaved defensively in this environment, but we do believe if you throw your cast back to the slide that showed just the evolution of the corporate debt stack in the US, you can see that a lot of the tail risk actually sits outside the banking system. It sits directly in pension funds, institutional balance sheets, and retail. Retail has unprecedented access to credit today. So we think our banks will come through this, and they are very interesting opportunities today. And then on the short side, it is really looking for some of the disruptors that ultimately are going to have far more cyclicality in their businesses and weaker versions of the stocks we own. Some of the cyclicals matching off against the parts of the portfolio that are more cyclical, looking for, in our longs, we're looking for cyclicals that are actually secular growers. In our shorts, we're looking for cyclicals that are genuine value traps, cyclicals that are facing secular challenges. And then the tail risk protection. In the long portfolios, typically it's the gold protection, and in the short portfolios, it's a combination of gold plus the credit protection and index put protection that we've had in the portfolio. Over the quarter, so I shouldn't touch the hardware. Over the quarter, we have built some additional exposure into some of the, let's call it the COVID beneficiaries, the online Asia EM. We ultimately think China can come through this in relatively good shape. Our cluster of Alibaba, JD, and Tencent, we've added to that cluster. Given the sell-off in energy, we have topped up some of the oil names that we think benefit from an acceleration of capital rationing that's going through at the moment. And that capital rationing is really hurting the shale. The US producers will be forced to cut supply, and we think that benefits the well-capitalized, lower-cost position companies in that area. On the reductions in positioning, you can see we've covered some of our index protection. We've also covered some of the more cyclical parts of the short book, the industrials short. We reduced in the developed world exposure in the online services area to companies that were directly exposed to travel. The key one there being Expedia. And we also took some size out of our Uber position. We've highlighted also just the evolution of the longs and shorts on a monthly basis. And, you can see from March to February, from January to February, we increased the tail risk protection. And then, we took out some of that protection at the end of March. So in summary, I know I've gone over time and we do want to open up for some questions. Life isn't, as we know, it won't necessarily go back to the pre-COVID-19 status quo. The fiscal, and in some ways we think, the countries that have had to do less fiscal stimulus to achieve stability are probably in better shape coming out of this. So it's really quite stark that China has only announced, some 2%, equivalent of 2% of GDP in stimulus versus the 10% that has been announced in the US and in Europe. We think that gives China a lot of flexibility to deal with COVID-19 on a longer term basis. And look, the debt to GDP in the US is, on the current trajectory is genuinely approaching, will potentially approach a level higher than what that economy experienced during the Second World War. I mean, that is historic. Now, we don't know because, maybe the US bounces back and the big deficits that are being forecast are too aggressive, but that is the current trajectory. Corporates will cut costs. They'll use COVID-19 as an excuse to do lots of restructuring. So employment may rebound less strong than many expect. And attitudes towards business travel and maybe office demand will be permanently changed. The key thing to watch, I think, is house price deflation especially in economies with high household debt, Australia, Canada, the Scandinavian economies. And then it's looking at changes in industry structure, potentially in retail, omni-channel survivors that have been hit hard can potentially emerge stronger. Market leadership may change. It's time to start thinking about the recovery cluster. And in the short book, take out some of the beta in the short book and look at some of the, let's call them more expensive defensive parts of the market that have behaved quite well, but will ultimately, in the weaker businesses, prove to have more economic sensitivity than is currently priced. So selectively add to dominant businesses in areas that have seen significant dislocation. So that is retail, financials, and travel. The heat map captures those, where those, with the dark blue areas, which are the areas that have been hit hardest, and the red areas, the areas where investors have crowded for protection. And we've, navigated this, let's call it a tough 2019, and which has really continued from a style perspective, the persistent outperformance of high multiple stocks versus low multiple stocks hasn't really changed. We've faced that dynamic. We continue to face that dynamic, and it potentially throws up opportunities. As Nick illustrated in healthcare, many of those low multiple stocks are not necessarily low growth or low quality. So it is throwing up, I think, PE or valuation dispersion is throwing up opportunities. I'll go straight to questions, I think, at this point, in the interest of time.
Yeah, well, thank you, Jacob, and thanks, Nick. Just before we go to questions, just a couple of key takeouts for me. It's clear that the world is rapidly searching for a vaccine, and ultimately there will be an end to this. In the meantime, it's clear that COVID-19 has brought forward a recession, and we've seen massive fiscal response from governments around the world, which is yet to play out. Active management is critical at this time, we believe. We think it's important not to pay too much for a company, but it's also important to identify those with good growth prospects. And Jacob mentioned just then some in the healthcare sector that Nick alluded to. Most importantly, having some downside protection is going to lessen the pain of the current crisis, and it'll help to smooth your overall returns. I think it's also worth noting that for those of you who are APL shareholders on the call, Jacob's comments relate equally to the portfolio as they do to the unlisted funds. So look, let's move now to questions. And firstly, Jacob, we mentioned the massive fiscal stimulus from around the world. How would you rate the response of different governments, and which companies and sectors will benefit, and how well are you placed to take advantage of that?
Thanks, Matt. That's a good question. As I mentioned, that Europe and the US is, really racking up around 5 times as much fiscal stimulus to stabilize their economies, and maybe you can pitch that as a positive, but let's face it, a lot of that stimulus is really going on one-off income protection. So you have to ask yourself, how did China get through this with less stimulus? And I think it exposes the vulnerabilities in the debt stack that exists in the West. That is, arguably, China in some ways has, potentially more, a broader toolkit for dealing with some of these issues. Importantly, you could argue that maybe the socialist nature of some of the Chinese responses, but I think stronger companies will come out of this in good shape. and our focus is in finding those stronger companies and countries that haven't had to blow up their sovereign balance sheet just to survive will also come out better, and because they'll have a balance sheet. The countries that still have a sovereign balance sheet that can be deployed for longer term productivity projects, whether it's decarbonisation or infrastructure, is ultimately better spending than, I know we have to protect incomes. I'm not saying it's bad policy, but it highlights that those countries led by the US went into this in a much more vulnerable balance sheet position than they had to be in. They chose to fiscally stimulate in a period of strong economic growth when they could have saved.
Question for you, Nick. Do you think that the US cases needing ICU is understated due to individuals avoiding going to hospital?
That's a good question. I think you have to look at individual regions of focus. In the case of the US, it's a large country and population densities vary a lot. New York, for example, has been a particular hotspot that's been in focus, and thankfully the policymakers there have provided us with very good data. I think the issue particularly there has a lot to do with population density, and that was where there was a risk that there would be, I guess, an overflow of patients requiring ICU in those areas. I think also with social distancing and the potential for some of these drugs to be used very early, which is what the data is indicating, that they may indeed help stave off some ICU presentations. So I think it's a combination of a few things. I would look for those very highly densely populated areas for that very risk that you raise. But more broadly across the country, I think it's going to be, there'll be very isolated cases of that. And the US machine that's been kicked into place to broaden bed capacity, for example, New York is adding 3,000 ICU beds just this month. And you've got companies like General Motors and a whole bunch of other ventilator companies ramping up capacity in production of ventilators. I think as time goes on and with this social distancing flattened curve, that probably the risk of that for the US is probably going to reduce over the next few months. Thank you.
Okay, question here for Jacob. Sorry to keep going back and forth, guys.
We're just practicing our social distancing.
You don't want the cops turning up here to wish you were fine. Jacob, putting on your figurative oracle hat, and this is a broad question, but looking forward 24 to 36 months, what does the USA look like, in your opinion, in terms of standing in the world economically and politically?
Yeah, I think that's probably a question that leads to the US dollar status as reserve currency, and whether it's through trade, war, or just the lack of, let's call it, the increasingly unstable isolationism, if you like, that's been creeping into US politics. We think there's definitely a question mark over what is the reserve currency for the world, and obviously that's one reason why we have some exposure to gold in the portfolios. And how do you get ultimately the fiscal deficit under control, without either taxing corporates, which is clearly going to be pretty unpopular amongst shareholders, and so it is the nature of the next administration. Do we have a swing? Do the Democrats? It's increasingly, it looks like Biden will be leading Democrats to the election. Probably has a decent chance against Trump. Will Biden, will he shift moderately to the left? Probably, but obviously not as extreme as Bernie Sanders would have. So there's probably, you're thinking you could be getting to the end of some of the big supportive trends of US earnings, lower taxes being the key one. that could start to reverse. Then it's just a question of what happens to, parts of the economy. We think housing is probably an area that you want to have exposure to. Ironically, lower rates and also a household balance sheet that hasn't been, it hasn't been the area where debt has grown in the US. Households have generally been saving. And if you think about financials, if you take our exposure to Capital One Financial, COF, now look, it does lend on credit cards. It lends, that's its primary business. Now you might say, well, why would you want that? Well, its customers are getting protected by the income stimulus that the US is pouring into the economy. I think, I actually do want to be exposed to some of in this case, the stimulus beneficiaries. I think it's extraordinarily cheap given the backstop that the government has provided to its customers. So be exposed to some of the benefits of the stimulus, and also look for the companies that have come out of this in stronger shape.
Thanks, Jacob. Look, I've got a couple of questions on this next theme. Your net exposure of 61%-ish suggests you are extremely cautious and don't believe in the market recovery that we've seen in recent weeks. What do you think is the probability of retesting the lows of late March?
Look, I think more than anything, it's the composition of longs and shorts, and what the net really hides, doesn't do justice to that. And we have been building into our long investment exposure some recovery exposures, which will have and will probably continue to do well. Retesting the lows, before addressing that second part, in the shorts, it's also just been positioning the shorts, taking some beta out of the shorts. You can see the single stock short book is actually lower. We brought that down, and the credit protection tends to be relatively low beta at the actual credit default swaps. And we still think there are significant downside risks in credit to the extent that the Fed is not bailing out high yield yet. Now they might be forced to, and I think that will lead to another wave of populism if the Feds seem to be bailing out private equity and other big users of the leverage loan market and high yield markets. But there is a real risk, I think, of this fallen angel dynamic. I didn't really speak to it that much, but with so much of investment grade, with roughly 40% of investment grade in BBB, one notch above junk, you are going to see this dynamic where the Fed, because the Fed is supporting investment grade, corporates will do everything they can to protect their investment grade rating, which in the case of some of those BBB companies means they will issue equity at any cost. So we are preparing ourselves for a whole lot of dilutive capital raisings. Some of those may be opportunities on the long side, and some of them may be opportunities on the short side, depending on the quality of the underlying business. A quality business that maybe have too much debt that gets fixed through a capital raise is a potential buy. But we are finally about retesting the lows. Look, from our perspective, we see that we see the bounce has been driven potentially more by the flattening of the curve more than anything else, which is good news because it points to a reopening of the economies. And as Nick pointed out, if we can build additional ICU capacity, even if we have a recurrence, we can potentially keep the economy open and control and manage those outbreaks because we have the sufficient excess capacity in the healthcare system. But we still are going to have a recession, I think. So, it's sort of thinking, when is the recession? Is the recession priced in? So don't fight the Fed. We understand that. And we are genuinely looking to benefit from the stimulus in the long book. And, in the short book, try and maintain the shorts in relatively low, take some of the beta out and keep it asymmetric. So make sure, to the extent we have hedges there, they're hedges that have genuine asymmetry in them. So we don't lose, we don't lose too much of the upside to the extent that the liquidity, really just starts to push animal spirits back into equities.
Thanks, Jacob. Just conscious that it's now 11:15 and we've been on for 45 minutes. So if there are those of you that need to leave, please feel free to do so. Look, we just have a couple more questions, Jacob. There's a question here on emerging markets. Somebody wants to know the views. We're hearing stories of big capital outflows. Strength of the US dollar is a bit of a concern. What chance of a big event like an Asian financial crisis type event?
Look, I think we're not wanting to keep referring to the Fed, but I think the Fed has done a great job in terms of easing some of the dollar, let's call it short-term dollar funding issues, which were probably less about EM sovereigns having issues and more about just supply chain shocks. Where most of the world's factory sits in Asia, and those companies get paid in dollars. And to the extent they have, they had lockdowns in their manufacturing capacity, their ability to pay their suppliers, and hence triggered this fundamental shortage of dollars. We think most of those stresses in a liquidity sense have been alleviated by swap lines that the Fed has put in place. The question on EM, let's take the two biggest EM economies, China, India. I think it's very clear that China hasn't had to blow up its sovereign balance sheet. Its starting position is debt to GDP in the government, roughly half of the US. And it seems to have been able to stabilize the economy, with a lot less stimulus. So I think that's pretty positive, for the outlook of consumption exposed equities in China. Now let's take the example of India. India does not have the same infrastructure resources that China has. So, we've exercised our minds a lot around about what COVID-19 means and how well the Indian authorities will be able to deal with it. They've had outbreaks previously of swine flu, which they've dealt with. I think, if you step back and you just think about the balance sheet position of the Indian household, across EM, India has one of the lowest household debt to GDP numbers. So we think there is, India will muddle through, and it's essentially the other EM that really matters. Brazil, I'm not saying Brazil. I can't talk about each country you have to go through case by case. But the two that we have, we have one stock in India, ICICI Bank. We think retail banking in India is a secular growth opportunity. And we've been, topping up our exposure in that because we think it's a great opportunity to buy one of those companies that comes out of this in a stronger position.
All right, look, we might leave it there, I think. Jacob, look, there are a number of other questions that we haven't had time to ask today, so we will follow you up directly. We know who's asked them, so bear with us. I'd like to thank everyone for joining us today, and thanks especially to APL shareholders who have joined us for the first time. Remember, we're doing these fortnightly, so the next one of these will be Thursday the 23rd of April at the same time. And you will also be able to access a replay of today's webinar by visiting Antipodes' website. That's antipodespartners.com and clicking on the Insights tab. Thanks again for joining us, and I hope you have a good day.